Ladies and gentlemen, good day, and welcome to the Q4 and FY26 earnings conference call of Religare Enterprises Limited, hosted by Adfactors PR. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Anisha Jain from Adfactors PR. Thank you, and over to you, Ms. Jain.
Thank you, Sapnali. Good day, everyone, and thank you for joining us today to discuss the Q4 and full year 26 business performance of Religare Enterprises and its subsidiaries. We have with us today the management of Religare Enterprises Limited and its subsidiaries. Before we proceed with this call, I would like to mention that some of the statements made in this call may be forward-looking in nature and may involve risks and uncertainties. The company undertakes no obligation to update any forward-looking statements to reflect developments that occurs after the statement is made. Documents related to company's financial performance, including investor presentation, have been uploaded on the stock exchanges and on the company's website. I now hand over the call to Mr. Pratul Gupta, Chief Financial Officer at Religare Enterprises Limited. Over to you, Pratul.
Thank you, Anisha. Good evening, ladies and gentlemen. Welcome to our Q4 and full year FY26 earnings conference call. I am grateful to you for your participation and continued interest in Religare Enterprises and its subsidiaries. FY26 has been an important year for Religare. We moved from recovery to rebuilding with significant progress across leadership, governance, capital availability, and regulatory response. During the year, the board of REL was substantially reconstituted with the appointment of Mr. Rajendra Mohan Malla and Mr. Shrikant Somani as independent directors, followed by onboarding of Mr. Arjun Lamba, Mr. Gurumurthy Ramanathan, and Mr. Suresh Mahalingam as promoter nominee directors, post the RBI approval in July 2025. Mr. Lamba has subsequently been re-designated as Executive Director of REL from 1st April 2026. Across all the operating subsidiaries, the respective boards have been strengthened with enhanced membership from the nominee directors as well as independent directors. I now take this opportunity to invite Mr. Arjun Lamba to give his opening remarks. Over to you, Arjun.
Thank you, Pratul. Good evening, everyone. As I stated earlier in our press release, we are building a foundation on which we hope to build a profitable, scalable, and sustainable business and remain committed to the same. To get to this stage, we are hiring the right talent, empowering them, incentivizing them. Some of the people you will be interacting with on this call are in the room with us, and many more will be joining us in the future. As a part of this process, we are also streamlining the group structure for efficiencies, both from a capital and shareholder perspective. Adequate capital has also been raised. The platform is now getting ready to give shape to the above vision for all four businesses, and you will hear more about this going forward. I will now hand it over to Pratul from here.
Thank you, Arjun. So I am joined in the room by leadership of all the operating businesses, and once we get into individual businesses, I'll mention about them. Let me walk you through our investor presentation. The presentation has already been shared with you and is available in the investor relations section on our website, as well as has been uploaded on boards. The respective speakers shall also be referring to this presentation during discussions. I am now referring to slide 4. While some of the audience may have seen this slide earlier, I would just like to refresh everyone's memory on our business overview. Religare Enterprises serves as the listed holding company CIC, which states in India's second largest standalone health insurance company called Care Health Insurance, as well as financial services businesses across Religare Broking, Religare Finvest, the MSME lending platform, and Religare Housing Finance, which focuses on affordable housing. Moving to next slide, these are the key highlights for FY26. As mentioned earlier, we have strengthened our leadership across different businesses, and I'll cover the details in the next slide. There is a strong promoter commitment from Burman Group for Religare. The promoters have subscribed to 50% of the preferential rights issue with commitment of rupees 750 crore during the year. I must also mention here that during the last quarter, the promoter group also increased stake in the company through open market purchases, and the current shareholding is around 30.3%. Upon conversion of outstanding warrants, this stake is expected to rise further. During the last quarter, the respective boards of Religare Enterprises Limited and Religare Finvest Limited approved a demerger scheme to create two separately listed focused entities. Under the proposed demerger, REL's lending, broking and ancillary financial services business will move to RFL, while REL will become a pure-play health insurance holding company through its stake in Care Health Insurance business. Post the implementation of demerger, RFL will operate as an integrated financial services platform, and REL shareholders shall receive one RFL share for every REL share held. Referring to slide 6, this just gives a snapshot of key management changes during the during the year. You have already been introduced to Mr. Lamba. He represents the promoter family. And as I mentioned earlier, he is now the executive director. The other key appointments are Mr. Ajay Kumar Shah, a founding team member of CARE with over 30 years of industry experience. He has been appointed as MD and CEO of Care Health Insurance in April 2026 and succeeds Mr. Anuj Gulati, who built CARE as India's second largest standalone health insurer during his tenure. Alongside Mr. Manish Vishnu Dodeja, a member of founding team and an industry veteran, has also been appointed as Executive Director of Care Health. At Religare Finvest, Mr. Srinivasan Karthik, with nearly 3 decades of banking and financial services experience, has been appointed as the CEO. He joins us from HDB Financial Services, wherein he spent the last decade to build consumer and asset finance portfolio across several products. He also played a key role in the digital transformation of the company over the last few years. At Religare Broking, Mr. Vijay Kumar Goel joined us as Managing Director of RBL in February 2026. Vijay has spent over 14 years at Motilal Oswal, managing different lines of businesses, and is an industry veteran. At Religare Housing Finance, Mr. Pankaj Rathi has been appointed as Chief Financial Officer and Executive Director to spearhead the growth and expansion of the franchise. Mr. Rathi served as CFO of Graham Housing Finance just before joining Religare. Now moving on to numbers, we are on slide 7. Slide 7 gives an overview of the financial performance of REL and its subsidiaries for Q4 as well as FY26. In Q4 FY26, REL reported a total income of rupees 2473 crores on a consolidated basis. For the full year, the total income was rupees 8,493 crores, and the reported PAT is at rupees 73.16 crore. Significant subsidiary CARE reported a GWP of rupees 3,511 crores during the last quarter of the fiscal and a PBT of rupees 274 crores. Both these numbers are on N basis. For the full year, CARE reported a GWP of 11,417 crores and a PBT of rupees 539 crores. RFL reported a profit of rupees 89 crores in Q4 on account of improved recoveries and has a cash balance including liquid investments of over rupees 591 crores currently. Religare Broking Limited reported an income of rupees 99 crores for Q4 and for the full year rupees 373 crores with 22 crores as PAT reported for the year. Religare Housing Finance reported a total income of around rupees 30 crores for FY26 and 8 crores for the quarter. The business reported a loss of rupees 18.6 crores for the year. I am on slide 8 now. This is just a snapshot of our income statement. As I mentioned earlier, REL reported total income of 8,493 against a total income of 7,405 reported last year. The total expenses is 8,407 crores for this fiscal and a PBT of 87 crores. The last year corresponding number for the PBT was 243 crores. On slide 9, we have got segmental reporting. The insurance business clocked a revenue of rupees 2,313 crore for the quarter and 7,969 crores for the entire fiscal 2026. Financial services were at rupees 166 crores approximately for the quarter and 537 crores for the entire year. The profitability for the insurance segment is at 41 crores for the last quarter, while it reported a loss of approximately 46.8 crores at PBT level for FY26. For the financial services segment, PBT of 127.5 crores was reported for the last quarter and 152.3 crores on the annual basis. The corresponding assets and liabilities are also detailed in slide 9. Now we will get into each operating business. I will hand over to Mr. Ambrish Jindal, the CFO of Care Health Insurance, to take us through the details of health insurance company performance. Over to you, Ambrish.
Thank you, Katul. Good evening, everyone. This has been a transformative year for India's insurance sector. The exemption of GST on individual health insurance policy materially improved affordability for customers by removing the 18% tax burden, which supported stronger demand across the segment. As a result, the industry saw robust momentum in retail health and grew at 30% in H2 of the financial year 26-27, and Care grew by 8% more than what industry grew in the same period. This financial year, we achieved multiple milestones. Our top line crossed 10,000 crore mark as we delivered gross written premium of 11,417 crore against 9,200 crore in the previous year. Our profit before tax, both under Ind AS and on N basis, crossed 500 crore mark. Profit before tax under Ind AS grew by 55%, excluding the impact of mark to market on financial instruments, while on N basis it grew by 38%. We continue to deliver mid-teens ROE for the fourth consecutive financial year. And this year, our credit rating was upgraded to AA family from A family, which helped us in raising a subdebt of 100 crore this year. Now, highlights for the quarter are this. Our retail business grew 37% year on year on a full premium basis, with continued market share gain in retail health insurance. Total GWP grew by 29%, again on N basis. Profit before tax for the quarter is 275 crores, and on a 1/N basis, it is 107 crores. Our digital transformation continues. 96% of our policies are issued digitally, and over 87% of cashless claims are processed in less than 1 hour. Customer complaints and grievances, we keep on focusing on this area. It has declined in quarter 4 as compared to previous year. Now let me walk you through the presentation. I am on slide 12. The company delivered a top line of 11,417 crores on a full premium basis, reflecting 24% growth, while retail health grew by 34%. Our AUM crossed 10,000 crore milestone and stood at 10,944 crores. We have a market share of 6.7% among industry and 22% within SAHI segment. Our solvency ratio stood at 1.68. However, due to mark-to-market losses in the equity book, solvency was lower by 2 basis points. Excluding this impact, solvency ratio would have been 1.70. And our claim settlement ratio is 97%. Moving on to next slide, we are on slide 13. Over the past 4 financial years, the company has delivered a strong CAGR of 30%. In the current year, the growth stand at 24%. Our retail health market share continued to expand, reaching 11.6% of the overall industry and 19.7% within SAHI. While N-basis industry data for retail health is not available, just to give you a perspective, industry grew at 20% on 1/N basis and Care grew 9% higher than the industry, leading to gain in market share. The organization is a multi-channel organization focusing on all channels, wherein agency channel contribute almost 42% of the total GWP against 40% in the previous year. Additionally, the retail mix has improved by 5% this year, which takes it to 66% on N basis. Moving on to the next slide, we are on slide 14. The investment book increased by over 2,500 crore compared to March 25, driven by strong business growth and capital infusion of 322 crores in September 25. Investment leverage stand at 4.07x. Portfolio mix consists largely of bonds and GSEC, which constitute 93% of the entire book. and investments are predominantly allocated to sovereign and highest rated instruments, with only 6% of the portfolio deployed in AA plus rated securities. Moving on to the next slide. The company benefit from strong promoter commitment with a planned capital infusion of 600 crore, of which 256 crore has already been infused in September 25. We operate as a multi-channel organization with a strong focus on retail health, offering products across all customer segments. Our distribution network is extensive with approximately 4.11 lakh agents. During the year, we added around 50,000 agents, and currently we have 239 corporate agents and bancassurance. A continued focus on disciplined underwriting and efficient claim management has led to an improvement of 120 basis points in the combined ratio basis Ind AS accounting. Now in slide 16, this slide highlights the key capabilities of company's robust mobile app platform. There are 12.5 million app installations, and currently we have 1.2 million monthly active users. 70% of active retail customers are now available on the mobile app. This slide 17, it compares company's financial performance across all three accounting methodologies, 1/N, N, and Ind AS. On a 1/N basis, profit before tax stood at 18 crores compared with 200 crore in the previous year. However, these figures are directly not comparable, as the previous year reflected only 6 months on a 1/N basis, whereas current year represents a whole year on a 1/N basis. On an N basis, profitability improved by 38%, with profit before tax rising to 539 crores from 390 crore in the previous year. Under Ind AS, profit before tax stood at 519 crores compared with 388 crore in the previous year. During this year, profit was impacted by a mark-to-market loss of 64 crore on equity investment as of 31st March due to geopolitical reasons at the end of March. Excluding this impact, profit before tax would have been 583 crores against 377 crore in the previous year. The combined ratio under Ind AS improved by 120 basis points to 101.4%. Return on equity based on profit before tax increased to 19.9% from 17.7% in the previous year. Moving on to slide 18. Number on this slide, they are on 1/N basis and is not comparable with previous year. Under 1/N methodology, our top line is lower by 1,000 crore and profitability is lower by 521 crore compared with N basis. Combined ratio basis 1/N is 106.7% against 102.8% previous year. Again, the numbers are not comparable. And basis 1/N, Q4 is profitable with 107 crore of profit before taxes. Moving on to slide 19. This slide presents a bridge between company's IGAAP financial and number reported under Ind AS. The impact of Ind AS 117 is 565 crores for the current year. As highlighted earlier, the impact of Ind AS 109 arising from the mark-to-market loss on equity investment is 64 crores. As a result, profit before tax stand at 519 crores. Excluding this impact, profit would be 580 crores. Within other comprehensive income, a portion of the debt portfolio has been classified as held for sale, resulting into a mark-to-market impact. However, since most of these securities are held in maturity, and hence the mark-to-market effect on the other comprehensive income is only notional in nature. Combined ratio improved by 120 basis points, driven by a 100 basis point reduction in the loss ratio and 20 basis point improvement in the operating expense ratio. Our underwriting loss basis Ind AS is 114 crore, which has improved in this year by almost 50 crores. On the next slide, this slide summarizes the equity bridge between Indian GAAP and Ind AS. As highlighted in the previous slide, the key difference arises primarily from the impact of Ind AS 117 and the mark-to-market effect on securities. Handing over back to sir.
And thank you, Amrish, for the detailed overview. I now invite Mr. Vijay Kumar Goyal, MD, Religare Broking Limited, to give his remarks on.
Thank you, Pratul. Good evening, everyone. Slide number 22. During the quarter, we saw a sharp rebound. Our PBT grew by 79% YOY to 12.9 crores. Our 41% growth we saw in the brokerage on the top line side, 44% growth we saw in the interest income, another 31% growth we saw YOY in the e-governance business. Overall, our funding book, the client debit book, grew by 75% YOY. On the full year basis for financial year 26, our overall top line saw a marginal decline by 2% and it came down to 373 crores. We saw our profit coming down by 26%. segment, our e-governance business grew by 13% and our interest income grew by 9%. During the year, our e-governance business saw a business partner expansion from 52,000 to about 61,000, and we had a one-time charge regarding the new labor codes. Slide number 23. This is just, you all know about it. Overall industry saw about 3 million accounts getting added in the last financial year, but overall the activity ratio has been falling from 2020 to when it was 40% is now.
Sorry to interrupt in between, sir. As you're speaking, you're not audible.
Thank you, Sapnali. Mr. Goel will just finish his remarks. I think we missed the last one and a half minute.
Sorry for this interruption. Good evening once again. I'll quickly repeat what I spoke about on the slide 24, please. Previous slide. Thank you. So our total income YOY grew by 18% from 83 crores to 98 crores. On our yearly basis, our total income grew from 382 crores, came down from 382 crore rupees to 373 crores. Our profit YOY was up by 79% from 7.2 crores to 12.9 crores. And for the year, our profit before tax came down by 31% from 42.9 crores to 29.6 crores. Our net worth saw an increase by 6% from 354 crores to 376 crores. And our assets under custody remained flat in 26 over 25. Slide number 25. Our daily turnover in the cash segment, YOY was up by 13. And on a yearly basis, our cash turnover, average daily turnover came down by 20%. So last quarter we did well, but overall during the year, our turnover had come down. On the derivative side, we saw a growth both YOY basis by 61%, and on the yearly basis also, our derivative turnover, daily turnover was up by 8%. Our active clients, the NSE active clients, on a yearly basis came down by about 2% from 2.5 lakhs to 2,45,000. But the unique traded clients on a YOY basis were down by 2%. On a yearly basis, they were down by 5% as compared to 1,48,000 clients who traded in 2025. Last year we saw about 140,000 clients trading on a yearly basis. Our financials, as I have already mentioned, you will see that our revenues are 98 crore rupees for this quarter, and for the year 373 crore rupees. And our profit after tax is 11 crore rupees for the last quarter, and for the full year it is 23 crore rupees. I'll just quickly cover that now. What are we trying to do in Religare broking? We are now trying to repair the business. The work is already started and put it on a high growth path. There are few initiatives that we have already taken. I'll just give you a quick brief. The first focus is to increase the traded clients. We have around 1 million registered clients, around 2.5 lakh clients who are active clients with us, and there are a lot of dormant accounts who can be reactivated. So there are processes and plans have been made to increase the active traded clients. Second, we have already started the work on improving our technology, the core trading technology, as well as the mobile and digitization, including some AI-related initiatives. And we are adding more products on the platform and improving the client experience as well as our team experience. There will be a sharp focus on growing the non-broking revenue through the interest income as well as the non-broking third-party distribution products like investment products and insurance products. We already do those products, but we are going to ramp it up significantly in the coming years. And process-led execution, we already have hired a person has joined who is a Six Sigma and Lean methodology expert, having long experience in financial services and similar organizations, with an objective to improve a lot of processes and automate a lot of things to improve the experience and deliver consistent experience. Thank you.
Thank you, Vijay, for this detailed overview. We will now move to Religare Finvest Limited. We are on slide 29, which gives you an overview of RFL. RFL is part of the financial services segment of Religare and is categorized as a middle layer NBFC. RFL currently has a core SME book of approximately 60 odd crores, along with surplus fund balance of over rupees 590 crores. The strong liquidity position has been made possible because of company's consistent focus on collections and recovery, with collection efficiency remaining stable at around 98%. The NNPA stands at approximately 0.8% and CRAR is at 261%, well above regulatory requirements. For the full year FY26, we have delivered a PAT of rupees 139 crores on account of improved collections and recoveries, with Q4 PAT alone coming in at 89 crores. The NOF, which is the key regulatory requirement, stands at rupees 821 crores. The tangible net worth of the company is approximately 900 crores, providing ample headroom for future growth. The quarter marked continued recovery from the loan book following regulatory cleanup, and asset quality remains stable, reflecting close portfolio monitoring. With the joining of Karthik, the CEO of RFL, the focus of the entire team is now towards rebuilding and growing the company. The cash is available, capital is in place, people are there, platform is now ready to do the business for the various business lines. Coming to slide 30, while it may seem like a slightly busy slide, the key takeaways are straightforward. All legacy issues have been conclusively resolved. There are no cumulative ALM mismatches. Balance sheet is entirely debt-free. IT platforms are getting refurbished to support future business needs, and RFL is now slated to emerge as a strong governance-led, capital-strong institution that is ready to serve its clients. Moving to slide 31, some of the key ratios. Total income for Q4, as I said earlier, stands at 42.6 crores compared to 22 crores for the same period last year, nearly double year on year. This growth again has been driven primarily by strong uptick in interest income, which moved from 18.2 crores as of last quarter of last fiscal to 40.6 crores in the previous quarter, reflecting sustained improvement in collections and recoveries. Net worth has grown steadily and is now at 900 crores. These ratios collectively reflect the financial strength of the platform and how the business has been managed during this entire turnaround phase. On slide 32, it is just a schematic of profit and loss statement. Pre-provision operating profit stood at 17.6 crores for Q4 compared to rupees 2 crores in Q4 of last fiscal. Substantial improvement driven by disciplined cost control along with revenue growth. For the full year, total income was at 121.9 crores against 75.4 crores for the previous year. The turnaround, as I said earlier, is driven by recovery momentum in the loan book, improved collections, and resolution of all legacy provisions. These numbers collectively reflect the strength of the company to collect from NPA pool, and the cash collection should now position RFL well for the next phase of growth. I will now hand over to Mr. Pankaj Rathi, Chief Financial Officer, Religare Housing Finance, for his remarks. Over to you, Pankaj.
Thank you, Pratul. Good evening, everyone. I've recently taken over as the CFO for the housing finance business. My immediate focus will be strengthening the foundation of the business, putting the right building blocks, and creating a scalable platform for sustainable growth. The housing finance company primarily operates in affordable housing finance segment, offering home loans and loan against property with an average ticket size of about 10 to 11 lakh rupees. At the end of the quarter, the asset under management stood at 243 crores, with product mix comprising of about 70% home loan and 30% loan against property. The company continues to maintain a healthy capital adequacy ratio of about 130%. We continue to hold investment grade ratings of BBB- from ICRA and CARE, reflecting the stability and resilience of the business. Currently, the company operates through a network of about 15 branches in 8 states in India. Our focus remains firmly on granular retail portfolio, supported by a strong capital base, which is about 186 crores. From a industry perspective, the affordable housing finance segment continues to benefit from strong structural tailwinds, supported by favorable government initiatives and increasing demand for affordable housing. In parallel, we also are undertaking a comprehensive IT transformation initiatives aimed at strengthening operational efficiency, enhancing customer experience, and building a future-ready organization. Moving to slide 35, the Indian retail credit growth story remains robust, with affordable mortgage segment continuing to witness healthy momentum. The affordable housing finance industry has been delivering AUM growth nearly about 20% annually. Given India's mortgage penetration stands at only about 11% of GDP, compared to significantly higher levels in developed economies, the sector offers substantial long-term growth opportunities. Moving to slide 36, which highlights the key operating and financial ratios of the company. For the quarter ended March 26, the company reported revenue of about 7.9 crores, with an average yield on portfolio about 15%. During the quarter, we witnessed improvement in asset quality, both in GNPA and NNPA numbers, declining to 3.5% and 2.5% respectively. The company continues to maintain a comfortable capital position well above the regulatory requirements. Coming to slide number 37, which presents company's quarterly financial performance. The total revenue witnessed is a marginal increase of about 7.9 crore from 7.1 crore. At the same time, operating expenses were reduced to rupees 11.5 crores from 13 crores, reflecting improved cost discipline and operational efficiencies. For the quarter, the company reported a loss of 3.6 crores as compared to a loss of 5.9 crores in the previous quarter. On a full year basis, the loss is about 18.6 crores versus 12.8 crores during the previous year. Going forward, our focus will remain on driving business with sustainable growth, improving operational efficiencies, strengthening the asset quality numbers, and progressively improving profitability. That's all from my side. Handing over to Katul.
Thank you, Pankaj. With this, we end our presentation and we are now open to take the questions. Back to you, Anisha and Supran.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star then 2. Participants, you are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all, you may press star and 1 to ask a question. We will take the first question from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Hi, thank you for the opportunity. Am I audible?
Yes.
Yes, you're audible.
Yeah. So the first question is directed towards Mr. Arjun Lamba, since he is representing the promoters. So I think in the last call also there were concerns raised regarding this demerger process and the holding company discount which can be created because of this sort of a structure. So now in this last quarter, we have seen promoters increasing their stake by open market purchase as well as this impending preferential allotment. So this would significantly increase their shareholding in Religare. And hence we wanted to understand if there is any further views on how we can avoid the holding company discount because of CARE being subsidiary to a listed firm.
Yeah. Hi. Thanks for the question. Yes, the promoters have increased their stake in the last quarter. I think the increase has been to the tune of roughly 4%. And post conversion of the warrants, assuming everybody converts their warrants, I mean, promoters should be close to about 34%. And this is a logical step. And we believe that the structure that we put in place sets a path. And for the current moment, that's the right structure. As and when things sort of materialize or change, we will get back to you. But we understand your concern and we well acknowledge what the investors are saying. So I'll stop it at that. And for us, number one has been to separate the FS business from the insurance business and to provide clean structure so that the shareholder can understand and the managements can be very focused in doing what they have to do. And whereas this question from yourself and other shareholders, which was there on the call, we will keep this at the back of our minds and we will see what we have to do at an appropriate stage.
Okay. And if we were to go down on that path, can this be being done parallelly, or it has to be done sequentially once the current scheme of arrangement gets over, which will take at least a year from now?
We will evaluate all this. I mean, we will evaluate all this and we'll get back to you. And because these are complicated, these restructurings are complicated, as you know, and they're time consuming as well. There are a lot of regulations and regulatory bodies that have to approve the same and forms. So we'll get back to you on this.
Okay. One more question was...
Sorry to interrupt in between, Sarvesh. I would request you to please rejoin the queue again for more questions.
Okay.
Thank you. We will take the next question from the line of Adarsh from Enam Holdings. Please go ahead.
Yes, sir. So the first question is on care. We put out our numbers on IFRS. So just wanted to understand, a lot of our peers, obviously listed separately, do indicate, especially Niva, does indicate their growth outcomes that they expect and where combines are likely to go. And hence we get a good sense of kind of profitability. Things kind of turned a little bit for health insurance, at least on the underwriting side this year, going by numbers of all the companies. So if you can provide some clarity on that, and maybe after this I'll take one question on the structuring.
Thanks, Adarsh. This is Ajay Shah from CARE. So, on the tailwinds have started with the sector from October. October to March, we saw a healthy growth of 40% in retail compared to 27% in half one. And we have no reason to believe why these tailwinds will not continue. So, I am bullish on the sector. On the profitability, see, currently our combined is at 101.4. It should come down near 100 in 2 years timeline. But more important, this combined ratio will not come because of claims or anything. This combined ratio will come because operating leverage will be better. And I expect renewal cost operating leverage will be the only game changer in this.
So, sir, if you're saying 100 and closer to 102 goes to 100, broad sense, would you think, the profit of care goes closer to about 800? Would that be a fair number? Maybe 700 to 800 crores? Because
that you can take out very clearly. That's okay. But we are only balancing ourselves on the combined ratio. That's the only measure we do.
Understood. Fair. Sir, the second question again on the structure, while you've tried to clarify, was that, as you said, there has been a creeping acquisition and post-conversion for a separately listed life insurer. I believe the promoter shareholding should be 26. In this case, we would be, the Daba family would still be short of it in case shares are directly issued. So what's the journey we can expect? Because even while we came out with the structure and a large part of the value comes from care, there is still limited clarity on potential timeline on when one can see a clean care share for the shareholders.
Others, I think the promoters have done what we wanted to or they wanted to do. I think the warrants itself convert by the end of March next year. There is time in that. And the shareholding is what it is. I mean, that's a number that is there fixed and etched in stone. And we will see at an appropriate time what we have to do. I mean, I cannot give you a clear-cut guidance as when what will happen, but we've heard you out and we'll see what we have to do and when we have to do. Yes, we understand that the value is in care. We are cognizant of that. That's why we are separating the entities, creating clear paths, and we hope to create value in the other entity as well. But well acknowledge what your question is, but I hope I have been able to answer what you asked me.
Thank you. Before we take the next question, ladies and gentlemen, in order to ensure that the management will be able to address all the questions from the participants in the question queue, we request you to kindly limit your questions to 2 per participant. If you have a follow-up question, please rejoin the queue again. We will take the next question from the line of Niharika Kamani from CapGrow Capital. Please go ahead.
Hi. A couple of questions. So first is, how do we plan to ramp up the NBFC division, and how do we plan to deploy the excess capital therein?
So Karthik is here, our new CEO, who just joined us about literally this week. So please excuse him. I mean, he'll give a few thoughts. We obviously I'll just give a broad motherhood statement, and then he can take it up from there. We want to kickstart the NBFC. We want to be a multi-product NBFC. We have this cash. It's all unlevered. We have to get our credit rating where we want it to be. Promoters are strong. So I think with this preamble, I think we should be able to start. And after that, it all depends on execution. I'll ask Karthik to fill us in a little bit.
Yeah, thanks, Arjun. So the aim is to create a multi-line NBFC, launching products over a reasonable period in terms of conceptualization, preparedness in terms of technology platform, and eventual launch into the market. So I think that's what we are going to see over the next couple of quarters from the NBFC.
Okay. And so my second question is, so as per IRDA, promoters of Religare should hold 25% in Care Health Insurance. So are promoters contemplating increasing stake in Religare further to...
Between Niharika,
Hello?
Your voice is breaking in between.
Can you hear me now?
Yes, please proceed.
Yeah. So as per IRDA, promoters of Religare should hold 25% in Care Health Insurance. So are the promoters contemplating increasing their stake in Religare to meet this regulatory requirement?
So, Niharika, I think it's 26% if I'm correct, but yeah, 25, 26, that's the right thing. We've increased our stake last quarter. We'll see as and when, at an appropriate time, we'll see what we have to do, and we'll keep you guys informed as and when we do something. But we are well aware of these facts and figures.
Okay, understood. So is there any plan of bringing in strategic investor on board, given Kedara Capital might want to exit, or what are your thoughts on this?
So we've not heard that Kedara wants to exit, but that's a question that Kedara would answer. But we've not heard that they want to exit. I think they are our long-term partners in this investment, and I think they remain committed to the cause as well.
Understood. Thank you so much.
Thank you. We will take the next question from the line of Vikas Srivastava from RBC Financial Services. Please go ahead.
Yes, thank you. Arjun, as you would have realized, there's only one thought on the shareholders' mind today. What about the reverse merger of Care? And I think the previous people asked the same question. And to be honest, we haven't got a clear answer on this. If Kedara is a long-term, there's some legal issues which a previous person asked. Can we amend? Is it possible legally to amend the current demerger in case you are able, for example, to either get Anuj as a promoter or Kedara as a promoter? It was good to hear that Kedara are long-term investors. That's one question. And related to that, can the promoters buy more stock in this financial year, considering that without violating the creeping acquisition takeover code? I'm assuming you can't because you're already going up 2% because of your preferential allotment. So there's a big gap between the look-through from 19 to 26, that's 7%. Every shareholder today has that. So I'm saying, are there any conversations with either Anuj or Kedara? Is there a possibility that they could become promoters? Because I don't see the Burman family getting to 26. Is there a possibility that they could join hands and become promoters? And the last question was a legal question. Can the current scheme be amended if we were able to get to that number of 26%?
No, I'll answer your last question first. We don't want to amend the scheme. Whether a subsequent scheme can be done, when it can be done, we shall see at an appropriate time. Now, whether we can increase our stake to 26%, that is speculative. Time will tell. We have taken a first step. What can happen with our other partners, that's an open question, and then we have not sort of decided anything on this front just now, and we'll take your thoughts on board. And we hear, again, as I said to the last participant, that we acknowledge and well taken, and we've listened. We've just also onboarded ourselves. We are streamlining everything, and we are conscious of what the shareholders want, and we will apply our minds and collectively, and we'll keep interacting with you, and we'll discuss this topic in detail when we have a plan and a view.
Okay, thank you. My second question was on Anuj. Is he going to have any, Anuj Gulati, is he going to have any role now that he resigned? Is there any conversations or any discussion, considering with his experience and being a founder, of any continuing role in CARE going forward?
So I'll just answer that question before the CARE folks also answer. See, Anuj's term, as 15-year term is what is allowed as per IRDA, and his term has come to an end now. And Anuj remains a 5.5% shareholder. We are very thankful, grateful to him. We have a great equation, and I'm sure he and we all have the best interest of the company at heart. But at CARE, Anuj cannot be there for a period of 2 to 3 years, if my memory serves me correct, and that's per IRDA guideline.
Thank you. We will take the next question from the line of Dikshit Doshi from Whitestone Financial Advisors Private Limited. Please go ahead.
Yeah, so some of my questions have been answered. Just couple of things. If you can broadly mention about the Religare Housing Finance and the Religare
Sorry to interrupt in between. Dikshit, could you please use a handset mode?
Yeah, is it better now?
Yes.
Please proceed.
Yeah, thanks. So some of my questions have been answered. Just couple of things for the NBFC and the housing finance business. If you can broadly touch upon that for NBFC, say which kind of product we are targeting, or at what yield or NIM we are targeting, and will it be like a branch-led model or a digital model? If you can just give some rough, rough picture.
Yeah. So this is Karthik here. I'll attempt at answering your question. But as Arjun said, these are early days for me, just getting my head around the entire structure in terms of the art of the possible here. But to come to your question, basically it'd be a mix of secured and unsecured products with a reliance on with a higher mix for the secured products. In terms of what is the distribution model, I think today there are certain products which require a local presence. There will be a need for a physical infrastructure, office, branch, etc. And there are products which are basically location agnostic, where entire onboarding, underwriting, servicing, etc. can be done digitally. So it will be a combination. There are certain products which will require a physical presence. They will be branch-led, but there are many products which are typically low-ticket products, which will be completely done in a centralized manner.
Okay, for the housing finance business, as a housing finance company, we are supposed to focus on home loans because we have to meet a regulatory threshold of 60% principal business criteria. So our focus will be home loans to the extent of about 60 to 70%. Balance will be loan against property. These will be retail, granular, secured. Of course, this is what we do, and a ticket size would be about 10 to 11 lakhs right now we operate, and it could obviously, it will be below 15 lakhs or so in terms of our strategy. It will be both in terms of digital sourcing and branch-led, but largely because these are tier 2, tier 3 city play, it will be through the branch network, and we will have adequate infra as we go along. These are the products which we will cater from housing finance company.
All right, that's it from my side. Thank
Thank you. We will take the next question from the line of Chintan Mehta from Puniska Family Office. Please go ahead.
Thanks for the opportunity. I just wanted to know when we are going to start disbursement in our Finvest and Housing Finance division. Currently, we are doing acquiring books or files, or we have not started yet. And any target in mind in next 2, 3, 5 years, kind of achieving any target of even 5,000 crore or 10,000 crore kind of? I think so. New leadership hire, so vision has been set up. So, if you have any.
Yeah. So currently we are doing insignificant, I would say about 10 crores a month, less than that. But as we go along and get the first round of capital, we'll start putting in blocks in terms of our infra and expansion both. And obviously, it will be supported by investment on the front line, on the technology and all of that. We can't put a number right now in terms of how much we will going to do in another 5 years, 10 years, but yes, the opportunity set is really pretty large. And I'm sure you would agree to that. But yes, we will start business gradually and slowly and increase the momentum.
These observations are for housing finance. I think Karthik would like to add.
Yeah, for the NBFC division, I think there is a period of preparation when we put the entire technology stack in place. As probably you're well aware, today's business is as much controlled by technology as much as by people, process, and internal systems. So there will be a period of build-up in terms of preparation time. And once we do that, I think the scale-up will be fairly rapid in terms of distribution, getting national and India. I think that's how we visualize this. And we'll definitely keep you posted, I think, more on a quarter-by basis in terms of what the near-term visibility in terms of specific product launches as we move forward. Yeah.
Okay, if you can do it early or guidance between, that would be great. And the second question is related to Lakshmi Vilas Bank deposit case, where we are at, and what was the last outcome, is our favor or not in favor, or what's happening at there?
So the LBB case is sub judice. We are obviously going to make best efforts to recover these money because it was an FT that was fraudulently taken away from RFL. So we have now initiated legal proceedings in the Delhi High Court, and we will keep you updated. But be rest assured, as our fiduciary responsibility, we will be making best effort to sort of get this money, and we do believe over time we should hopefully be successful.
Okay, yeah. Thanks for the.
Before we take the next question, a reminder to all, you may press star and 1 to ask a question. We will take the next question from the line of Parvesh Patel from Patel Investments. Please go ahead.
Hi, sir. Thank you for taking my question. My questions were more in the line of a valuation perspective. So, the first one is that over the medium term, 2 to 3 years, can you give me a strategic roadmap for a...
There is a lot of echo. We couldn't understand your question. Could I request you to just
Keep the mouth away.
Yeah. Keep the mouth away and...
Can you try again? There's a lot of echo, please.
Is it better now?
Yeah.
So my question is more on the valuation side of the modeling side of the business. So over the medium term, let's say 2, 3 years, can you help me with a strategic roadmap for our verticals like insurance or broking, NBFC, housing finance, more so in terms of growth aspiration and capital allocation?
So, Paresh, I think we obviously raised capital at REL level to fund the growth of each of these businesses. And I'll just break it up. Out of the 1,500 crores, 600 is going to CARE, 250 is going to the housing finance company, 200 is going to the broking entity, and there's about 375 odd crores, which is a general corporate purpose fund, which can be allocated, depends on the need of these businesses. RFL, as you know, the NBFC is well capitalized with about a 900,000 crore net worth and 600 odd crores cash sitting with it. So that obviously does not require any capital. Our intent is to scale all of these businesses to make them meaningful and sizable, and part of this demerger is on account of this. And as these business teams, as with Karthik and Vijay and Pankaj and all get comfortable in their positions, we will update you on the business plans on a quarterly basis, and I think we'll be able to share more. But be rest assured, our aspirations are to grow these businesses, and that will be the endeavor of the managements of each of these businesses. And Care, I mean, Care is in any case growing very strongly. They've grown the healthy 24% plus. I think we plan to hopefully maintain momentum, and Ajay and Amrish can say a little bit about that. I think they are best suited to say that.
Thanks, Arjun. So tailwinds remain with the sector, and we should be able to capitalize on that.
Thank you.
Got it. So, my second question was moving towards Care itself. So, as you said, we have delivered a strong GWP currently, and we have also get market share. So, I just wanted to know, moving forward, what is the kind of sustainable growth rate that we are looking at, probably over the next 3-4 years?
Yeah. So we are expecting a healthy growth rate, but the way we measure is we should be growing better than the industry. That's the only benchmark that we carry.
Got it. Got it. If you could give a range to me, that would be better.
So range can be anything between 18 to 24.
Thank you. We will take the next question from the line of Karina Kaur from Starklium Capital. Please go ahead.
Hi, good evening. My question is the leadership and management largely in place, or are you looking at hiring more senior people, and in which business?
So that's a simple question to answer. So most of our leadership, at least at the CXO level, CEOs and CFOs are there. I think what is required is the CEO for the HFC business. We are in the process of that. And CTOs will be coming in for each of these companies, and then it will be BAU going from here. But that's ongoing process, and I think we are making good headway on this process as well.
Okay. And my second question is, do you expect the individual businesses to turn around in FY27 and report profit in the same?
So just our NBFC is already reporting profit. Our broking business is already reporting profit. Our HFC is the only one that is not reporting profit. I think maybe give it another 12 to 18 months. I think that would be a fair ask because we have to scale up, and scale up will require some OPEX and CAPEX. So just give us 12 to 18 months on that.
Okay. Thank you so much.
Thank you very much. Ladies and gentlemen, we will take that as the last question. I now hand the conference over to Mr. Pratul Gupta for the closing comments. Thank you, and over to you, sir.
Thank you, Sapnali and Anisha. We thank our shareholders for their faith in us, our customers for choosing our product and services, regulators for their engagement, our employees for their dedication and hard work. I also thank the entire leadership team present here with me in the room for taking out time and responding to our investors. Thank you, everyone, and wish you a good evening. Thank you.
Thank you.
Thank you. Thank you.
Thank you, members of the management. On behalf of Religare Enterprises Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines. Thank you.